So, ladies and gentlemen, for me it's a pleasure and an honor to be the moderator of this very ambitious panel that is going to identify and measure the scars and scratches of the crisis. And I would like, as a first question, to ask which crisis, because as a matter of fact, we cannot talk about one crisis, but there's a chain reaction of crisis that started 10 years ago, but that is still continuing. From a simple banking crisis to a full-fledged worldwide financial crisis to a worldwide recession crisis. In European environment to a sovereign crisis 3 years later, and later on to a monetary crisis 2 years later, leading to the unconventional measures of the central bank. And then later on in Europe, a migration crisis. So the crisis shifts from financial to monetary to sovereign to pure political. Migration crisis, and now to a pure political crisis of nationalism, not only in Europe but worldwide, and protectionism, and where even in Europe, member states are now openly blamed for not respecting the liberal world order, which was so precious for Europe, but is increasingly under pressure. So the question is, and then you have the UK as the symbol of the big question mark about the future of the European construction. Each of these crises is more or less under control. None of them is resolved. So it's extremely complicated to identify today the scars and scratches, because every day we get new ones. Some are visible, some are invisible. But if then, on the other hand, I look simply at GDP as a monitor or as an indicator of economies, I see almost no change. You see two dips in 2009 and 2012. But today, economic growth is almost at its average since 2000. So is the world now completely in a confusing chaos, or is everything fine? And are we worried about something where the economy is not really suffering? Fortunately, in this confusing environment, we have an excellent panel of experts who will give us their opinion and how they look at the situation. We have Cinzia Alcidi, Senior Research Fellow of CEPS, William de Vijlder, Chief Economist Group, Chief Economist of BNP Paribas, Eva Ortega, Head of the Modeling Unit of Banco de España, and David Turner, Head of Macroeconomic Analysis at OECD. You cannot hope for a better panel. So I would now like to give the floor to Cinzia to give her view of the situation.
Thank you very much for the invitation and for the introduction. You actually put very important, very difficult questions on the table. And indeed, the question is rather difficult. And the way I'm going to address the question is basically looking at something that I wrote in 2010. So in early 2010, well before the Greek crisis and all the crises actually that you mentioned, with my boss, we tried to answer the question, what is the impact on the real economy coming from the financial crisis? And I think it's worthwhile to mention two main conclusions from that work, because I think they're still valid, and basically I will use them to make my main point today. The first point that we had in that paper is that actually if we want to assess the impact on the real economy of the financial crisis, it would be misleading to take 2007 as a benchmark. And maybe one of the other panelists will explain this better. So I won't spend much time on this, but well, there the idea is that 2008 basically was the peak of bubbles. We had a global credit bubble and a number of housing bubbles in member states. So to some extent, GDP was altered or inflated by the existence of those bubbles. So we should look at a different benchmark. The second point that we make in that paper is that if you want to have a sense of how costly will be the effect of the crisis on the real economy, you need to look at the imbalances which have been accumulated during the crisis. And in particular, on whether there was a building up of overcapacity. And I have to admit that at that moment we didn't do any fancy econometrics or modeling, but we just looked at one basic indicator. We focused on Spain, where it was known that there was a bubble, and in Ireland, and we look at the size of the construction sector, and it was 21% of GDP. Now, just to give you an idea, the average in the euro area is about 11%, was at that time 11%, including these two countries. Now, this gives you a sense of how large the impact of the crisis could be on the economy, because basically you have at least 10 percentage points of GDP which have to be reduced. This is going to have a very large impact on the real economy. And then the question is, okay, so what? And sometimes when I explain my students these facts, that they ask me, why then no one did anything to prevent this? You don't move from 10% to 20% of GDP from one day to another. And I think that the answer is actually quite simple, and is that when you are in a booming phase, when you have these kind of bubbles, almost everyone enjoys it. So you have people who are happy to buy new houses, they have the dream of having a house, banks are making profits, and governments get revenues. So it is actually very difficult to break this sort of party. And actually, it's most of the cases in the hands of central bank to stop the party. And this is very difficult. And then the question is whether this kind of a crisis just leave scratches, so something which is, okay, you have negative consequence, or whether you are scars. You have scars, so something which is much more pronounced and long-lasting. And I think if we want to understand this and to make an assessment, we need to look at how financial variables, key financial variables, develop. And basically, since 2010, there's been a lot of literature and a lot of economic research in trying to understand how this happens. And a lot of research has been done on financial cycles. And this actually allows me to make a reference to what the governors said. Development in financial cycles have been studied mostly for macroprudential policy purposes. So it is really the idea of monitoring certain variables which could lead to bubbles and bursts and avoid that you reach those kind of situations. But I think that the analysis of this kind of phenomenon are actually interesting also if you want to look at the real economy. And this is basically what I have done. I'm putting in this slide some estimates of the financial cycles across euro area member states. This basically, the idea is to extrapolate movements in credit indicators and in house prices. I won't go into the details, but basically, if you look at this point, this is 2008, this is the peak of the financial cycle for a lot of euro area member states, and these two on the top side are countries, probably the usual suspects. You have Greece and Spain. And just below, this is Ireland. Now, one question is, how can this kind of indicators helping us to see whether there are developments in financial cycles which can have impact on the real economy? And then the story goes back to my initial point. If development in house prices and credit is just a price effect, it's just a price matter, then the effect on the real economy are likely to be limited. But if this development actually leads to misallocation of resources, the impact is likely to be very much long-lasting. And if we look at the duration of the crisis and the effect of the crisis in a number of countries, this is actually likely to have been the case. And when I talk about misallocation, basically, of resources, basically what I have in mind is that during the booming phase, you have the source of the problem, where you have allocation in certain sectors, for instance, the construction, but also other sectors, usually non-tradable sectors, are those who manage to attract a lot of the resources. And then you have the crisis, and if this coincides actually with the banking crisis, like it was the case in a number of countries, during the recession it becomes very difficult and takes quite a lot of time to move towards optimal reallocation of resources. And this is mostly due to the fact that if you have a banking crisis, banks are busy to clean up the balance sheet. And this is basically one very idea of why we may see scars for a certain number of years before actually the economy goes to some normal. And 8 years, because basically 2008, 2016, 17, it is basically the length of the recessionary phase of the cycle. This coincides more or less also with the economic recession. And this is quite exceptional. This is a very long one. Now, what does it mean this for the future? This is not up to date, but what you see is that the financial cycle has basically reached the bottom already in 2016-17 in most countries, and now it is in a growing phase. And when the financial cycle is in a growing phase, actually there are reasons to be optimistic. So a bit of the optimism that it was mentioned by Freddy is driven by this phenomenon. So the credit growth is increasing, house prices are taking up, and the economy is actually in a good mood. Now, is that fundamental, or there is still something wrong? Well, one of the problems is that when you have a crisis, financial crisis, which are led by a credit bubble, you have accumulation of debt. And when you have the bust, in principle, you should have the adjustment, the leveraging. Now, the very fundamental question is whether the process of the leveraging, and I'm not just talking about banks, this is really about the economy in general, has actually happened. I'm not showing you the data, but basically, if you see at the economy as a whole, what we have experienced in last year is no more growth of debt, but actually not large scale of the leveraging. So basically, one of the risks which is looming is that we have entered actually a growing phase of the financial cycle, so again expansionary, but we still have a lot of debt. And this is maybe one of the main sources of risk in the years to come. This is not a matter of today or tomorrow, but maybe the main source of risk for the future. And I will stop here. Thank you very much.
Thank you very much, Cinzia. So if I may naively summarize in one optimistic sentence, there are good years ahead unless the central banks prevent us from getting out of the bottom. Thank you very much. William, the pointer.
Thanks to the organizers for inviting me at this conference and to make a contribution. What I've prepared is a set of slides, quite numerous, so I will not show them all. If you're interested in having a look at them more closely, they'll be posted on our website next week with an accompanying text. The title is The Uncomfortable New Normal. I was thinking like, okay, the new normal, so which word should I put in front of that? And I just ended up with uncomfortable. How do I get there? I get there by looking at today compared to 10 years earlier from 5 perspectives. Flows, that is activity, income, use of production factors, employment. I look at balance sheets, I look at the pricing of financial assets, I look at what's happened in developing economies, and I look at the policy leeway. So what I will do during my presentation is to come up with a very judgmental assessment of how we score on these different dimensions. And then the effort at the end will be to kind of then say what is the overall conclusion. And as you have understood from the title, the overall conclusion is it's, let's say, a bit uncomfortable. Now, admittedly, this is a partial analysis. It does not cover, for instance, financial stability. It does not cover market liquidity. It does not cover the infrastructure and all these things. Some of these areas I happily pass on to the other panels. I think they're very complex, so I'm really looking forward to how they will talk about it. It's also quite, I would say, ironic or sad that we can read on the Financial Times website this morning that a very well-known Norwegian energy trader has blown a hole of $100 million and which has forced the Central Clearing Authority to send a letter to its members to please can you make up for this as a kind of a pooling of risk. So 10 years later, have things really changed in certain areas? I don't know. Okay, flows, activity, and so on. It's very simple. I just invite you to spot the vertical line, which is 2007, and then where are we today? Very often people look at GDP, per capita GDP, and then they say, okay, we've moved above the levels pre-crisis, so in the crisis of 2008, the Great Recession has been digested. Looking at per capita GDP, in most areas this is indeed the case. Italy is still a major exception. The unemployment rate has come down significantly in most countries which I cover, and it is a very small sample, I admit. We have kind of converged towards the previous lows. Spain is an exception. The labor force participation rate has increased simultaneously in Europe, so that's a good job. Unemployment rate down, labor force participation up. On the other hand, core inflation is still flat, and it is in the Eurozone, and even in the US, despite unemployment being really equal or below the natural rate of unemployment, and a very mature stage of the business cycle, core inflation has still not yet moved above the Fed's target. So my judgmental assessment on activity flows and so on is green. We can have a lot of debates on how green it should be, but I put it green. Okay, feel free to disagree. Balance sheets. Balance sheets, you have an asset side, liability side. Asset side, I'm looking at two assets, equities and real estate. The S&P has recovered, started to bottom out in March 2009, which is very quickly actually, considering that Lehman collapsed on the 15th of September 2008. And since then it has been a huge bull run for all sorts of reasons. Euro stocks, the yellow line, by the way, is quite a different story. Real house prices, let's say with the exception of Germany, but I do not look at the levels where we were back at the end of 2007. In Germany, they have moved up a lot. In other countries, we have now more or less moved, converged back to the real house price level, inflation adjusted, that we had at the end of 2007. Italy is an exception. Spain, understandably, is an exception. Then talking about the liability side, debt, Cinzia referred to that. There has been some deleveraging in the US. That is a red line. That really stopped in 2012 when everybody became convinced that the expansion was there to stay. So since then it has been stable. Eurozone households haven't really delevered. French households have increased their leverage. Now, this point, actually, there is a kind of an ambiguous relationship, because if you have a very expansionary monetary policy, you would have actually hope that people react to that and that they go to their bank and ask for a loan. Working for a bank, we appreciate that loan demand picks up. At the same time, high levels of debt or the absence of deleveraging, of course, raises the question that next time around, if interest rates were to be cut, there is a concern that the sensitivity of loan demand to interest rate cuts would be lower, considering that the starting level of debt as a percentage of income has been higher. corporate debt, very mixed picture, massive deleveraging in Spain, also in Italy. US, the red line, they have relevered. Eurozone basically flat. French companies have relevered, but that is also related to the head office acting as a pass-through for their foreign subsidiaries. And then public sector debt. Public sector debt has gone through a big jump, which is quite normal in a recession. You have automatic stabilizers and discretionary fiscal policy. And since then, well, how to put it? Germany is the odd man out, the green line, and otherwise it has basically been stable at a high level or even increasing. If you look at US, where amazingly in an economy which is going flat out, a pro-cyclical economic fiscal policy is being conducted. This of course raises the big question of what do we do when the next recession hits. So all in all, I would say balance sheets, that's orange. You have the range below. Then looking at market pricing, high yield spread very low in the US compared to US treasuries. In 2007 they were actually even lower. That's a kind of an element of comfort. What it shows of course is that financial investors have a capacity to forget or a capacity to focus on the short term, which is quite impressive. We all are aware of the price earnings multiple of the US stock market, which has moved up significantly. We are now well above where we were at the end of 2007. Then we were at 25. This is the Schiller index. Now we're at 33. We've had worse, but okay. So the reason why I show this is that it kind of gives you a feeling that if the real economy would go down, considering that you have prices of financial assets in certain areas which are a bit stretched or rather more stretched than a bit, the sensitivity of course could be high. So also put this orange. Then developing economies. There's been an abundant literature about the spillovers of the US monetary policy cycle globally, including to developing economies. Now, this is JP Morgan Emerging Currency Index. You see a long-term downtrend, which means that emerging currencies have started to weaken since really the mid-2011, after a period of strengthening. Sadly, the index was only created in 2011, so we do not have the part between 2008 and 2010, which I would have been keen to show. And why is that? Because interestingly, if you look at corporate debt in dollars, something that the BIS has been hammering on quite significantly, you look at the black bars, and in quite a number of countries, you see a significant increase of foreign currency debt of emerging corporates in 2018 compared to the low point of 2012. So I have the impression that the very easy policy environment in the US with low interest rates and the recent experience of strengthening emerging currencies has been an invitation to take on debt in foreign currency, although everybody should know that at some point the currency will go in either direction. And this is something which I think is a big issue, because you then have to say, well, what should we do in terms of financial stability, supervision, regulation, whatever, to kind of wave the flag that this is something that may come back to haunt us at some point. The experience of Argentina and Turkey, of course, is a kind of a, let's say, a tough wake-up call in that respect. So I'm also putting this at orange. Policy leeway. On the fiscal side, this is structural budget deficit. Now, the structural budget deficit as a percent of GDP, actually, it's a bit better than at the end of 2007. So if you look at it from a deficit perspective, it means that if at some point we will need to increase the deficit, there should be leeway. That's the good news. Now, keep the champagne in the fridge, because if you look at the debt, of course, it's another issue. This is the other slide which I had shown. So the concern I have is that the leeway would be constrained not by the deficit, but by the debt level. And markets, of course, market pricing, look at the debt level and not so much at the deficit. Of course, you can then develop all sorts of reasoning that if you have a flight to safe assets, even highly indebted countries may even benefit from lower interest rates, and that the constraint on policy leeway would be untied. I would expect that if US, for instance, would go into recession, despite the fact that that GDP will probably reach 100%, that it would still have policy leeway for the very simple reason that there would be demand for what would still be considered a safe asset, although perhaps a bit less safe than in the past. And then monetary policy, very simple. Look at the minutes of the FOMC meeting at the end of July, where the participants agreed that the zero lower bound would be met, or the effective lower bound would be met more often in the future than in the past, would be met simultaneously in different countries, that the policy leeway for counter-cyclical policy in the US is constrained by the current pro-cyclical policy, and that as a consequence, the discussion needs to be broadened on how to address a future challenge. So I put the orange, I guess you expect what I'm going to put as a color for policy leeway as well. And all this leaves us with the following picture, that is that basically where we are today, in summary, is a bit of green and different shades of orange. I leave it to you to decide the intensity of the orange or the intensity of the green. But I think it is a big issue. Now, fortunately, this morning coming over here, I was looking on the train at a presentation of Olivier Blanchard, which he gave at the Peterson Institute. So who am I? I would not even dare to raise my finger, but who am I to kind of question his conclusion, which is that, yeah, even in a more extreme recession, we would still have possibilities, policy leeway to cope with that. Looking at it from a European perspective, I think that this is an invitation to have a close look at this, if only because if you think about, for instance, the balance sheet expansion, well, if you're at your limit in buying bonds for a certain country which has a healthy economic and fiscal situation, what will you then do? So with that, I want to leave you and pass it on back to Freddy. Thank you.
Thank you very much, William. Quite impressing to tackle 30 slides in 10 minutes, but I know you're able to do so. And the conclusion is more or less the same, I think. The world looks blue, but somewhere there is an overheated financial system, excessive debt, where there is doubt if there's enough resilience in the system to survive a recession, despite some optimism. Okay, Eva, could you give your opinion?
Good morning, everyone. I want to first thank the organizers to have me here. It's a great pleasure. I'll try to focus on a different aspect from the interesting areas that were put forward in this panel first. So I will focus on the natural rate, how low is the natural rate in the new normal. I'll try to link it to the productivity slowdown and especially the demographic trends. So as Mr. Governor put it before, a very important ingredient of the new normal is the low natural rate that conditions the space for monetary policy. Natural rate is an equilibrium concept. There's many definitions for that. Essentially, it's the equilibrium real rate, the equilibrium real interest rate, or the real return on capital that equates savings and investments and bring output to its potential. So essentially, it's a long-run concept, is a metric towards which the real rates gravitate in the long run. Now, the link to the business cycles and to inflation is that setting the real rates, by setting the real rates to the natural rate, we can stabilize output gap and inflation. How to measure natural rate is a very difficult issue. There's many approaches to it. One very popular one is the Laubach-Williams model, in which basically you decompose the natural rate into growth-related components, demographic, technology growth-related component, and another non-growth factor that may be financial risk aversion, and then plug in aggregate demand equation and a Phillips curve. You can also estimate it using DSG models or purely filters. I wanted to show you some estimations on the right-hand side for the euro area. On the right-hand side, you have different models, a variety of models, including Laubach-Williams styles or filter models This is based on a forthcoming publication as an occasional paper of the ECB, which is a report that was prepared for the Monetary Policy Commission of the Eurosystem by Klaus Brandt, coordinated by Klaus Brandt. It basically shows that in the last 2 decades, it's the downward trend in the real rate equilibrium is pretty obvious, no matter how you measure it. And in the wake of the crisis, it touched negative grounds. Now, on the left panel, you have a much longer historical perspective. This comes from a work from colleagues of mine of Banco de España, and it's basically filtering the trending component out of the short-term real interest rate. This comes from a historical database published by Jordan, Schularik, and Taylor in 2017. And this is 17 advanced economies data from 1891, so it's 125 years. So basically, this downward trend in the natural rate it's a worldwide phenomenon that was here way before the crisis. So if you can see, basically there's a downward trend until the 60s. Then there's an upward trend peaking in the 80s, and the downward trend that we are all concerned about later on. Now, I wanted to dig on the trending factors that may be in this downward trend of the natural rate. So one prominent one is basically population growth. So the European Commission for the euro area is projecting a change from 0.45% annual growth of population in year 2000 to minus 0.4% population growth in 2050. So composition, what's the ingredients of this change in demography? This is not news to anyone, but what's the ingredients of these demographic trends? So on the left-hand side, you have a clear lower fertility rates. So in gray is the projections from 2018 onwards, but until then, it's clearly lower fertility rates. In the middle panel, you have lower mortality, so basically higher life expectancy at birth, both males and females. And on the right-hand side, you have a change in the composition of population. This is the old age dependency ratio, which is the share of 65 plus years over the share of people from 15 to 64 years old. So this share was 25% in 2000, and it's projected to reach 50% in 2050. So what these elements are doing to the natural rate. So if we put these ingredients into macro models that take into account the demographic composition, the change in population, these are overlapping generation models. The channels through which these changes in demography are transmitted into the natural rate, basically, lower fertility rates, they mean lower labor input. They mean lower marginal product of capital, lower investment, and hence lower natural rate, lower real interest rates. Lower mortality, this higher life expectancy, basically means that people will save more in anticipation for a longer retirement period. More savings means lower real interest rates in the equilibrium. The raising share of old people, the changing composition, so older people de-save, so that means lower savings, so that could be a compensating factor that would raise the natural rate. Overall, what the macro models, overlapping generation models find, at least for Europe and in general, is that the first two elements dominate. That is, lower fertility rates, lower labor input, and lower mortality bring down the natural rate. By how much? Well, their estimations is that in the last 40 years, from the 80s to now, these changing trends in the demography may have accounted for almost 1 percentage point of the drop in the natural rate in Europe. And they project a further 0.5 half percentage point in the next decade. So so this is the channels through which the demographic change may permeate and may sustain lower rates, lower real rates, lower natural rates. How important are the demographic factors compared to other factors? So here, plotting the natural rate, actually this is the mean, the natural rate for the euro area, and the contribution of the demographics, which is the gray part, TFP growth, which is the dark blue, and risk, which is approximated by the term premium, trying to approximate a time-varying version, a time-varying measure of risk aversion. So essentially, demographics explains the rise of the natural rate until the 80s with the baby boomers and the fall since then, but also risk aversion has played a role. So a rise in the risk aversion after the great global financial crisis, flight to safety has brought down the real rate of safe assets and the natural rate. Now, how about the future? So how about what these demographic trends are bringing to the natural rate? As I said before, the estimations are that they will continue bringing down the natural rate for the next decade. So a turn to higher natural rate could come from either bringing down risk aversion or technology-driven boost in productivity with structural reforms, for example, or pension reforms that affect savings decisions. So what can policy do to reverse this declining trend in the natural rate? So we can have structural reforms that help support productivity growth and investment, enhancing competition and then the incentives to innovate and invest. Reforms towards more efficient public administration that reduce the loss of resources, training and education that reduces the skill mismatches and helps the diffusion of technology and growth of more innovative and productive firms. In the euro area, completing banking union can help in two ways: by more efficient allocation of financial resources that enhances potential growth, but also attenuating the flight to safety, reducing the risk aversion, and hence increasing the equilibrium rate of the safe rate of interest. What other policies are there, especially affecting demographic trends? Well, there can be increases in the retirement age that can mitigate the decrease in the natural rate due to aging. Also changes in the pension system replacement rates, but these can be complemented by policies that can encourage the labor force participation and the human capital accumulation so that we can boost investment rates and sustain the productivity of older age cohorts, especially if they are going to stay in the labor force for longer. Thank you.
Thank you very much, Eva. A little bit out of the box thinking. So if I understand, your analysis is a justification for low, zero, or even negative interest rates for a long time, which is good news for those who are excessively leveraged, because then having debt becomes a cash cow. And the second good news is by 2080, fertility will rescue us from eternal negative interest rates. Thank you very much. David, it's up to you.
Okay, thank you for inviting me. I'm going to focus on one component of the question that was put to the panel on the costs of the crisis. Basically, I want to make one point, which is an appeal not to exaggerate the costs of the crisis, or to put it more bluntly, I hate this chart. This chart appears in all sorts of guises. Sometimes it's for GDP, sometimes it's GDP per capita, sometimes it's productivity, sometimes it's for individual countries, sometimes it's for groups of countries, here the OECD. And it appears in all sorts of places. It regularly appears in the Financial Times, it appears in academic journals, and it even appears in the publications of reputable international organizations. This is the point where I should make that disclaimer about it's me speaking and I'm not, you shouldn't attribute what I say to the OECD, but actually that disclaimer goes both ways. So not everything the OECD puts out I agree with. And this chart is silly unless you believe in an asteroid theory of the financial crisis. That is, the economies were going happily along, and suddenly they were hit by an exogenous event which had nothing to do with what was going on in the macroeconomy at the time. And that's just not a plausible story. Economies were overheating, and maybe we We didn't see that at the time. Policymakers missed it. The economics profession at large missed it because we were focused too much on inflation. But in hindsight, it's obvious there was overheating in asset markets and in financial markets. And Cinzia's wonderful chart, I think, makes that point in spades. So basically, the dashed line was never on the cards. We never had the possibility of achieving that dashed line. So how should we think about the costs? Well, the red dashed line I've put on here is an extrapolation of potential output per capita for the OECD. So to make it clear, it's not what we think potential output is now, it's an extrapolation of trends that were taking place between 2000 and 2007. And you'll notice it's much below the blue dashed line. So why is that? Well, first and foremost, it's not fooled by the cyclical peak that was in 2007. So it starts from a lower point. And starting from a lower point, it also means the trend is less pronounced upwards. Instead of it starting here, you've got a slower trend. I think the other key point is that it starts in 2000 rather than a trend going further back. And the reason for that is productivity, or GDP, but productivity in particular, was slowing well before the financial crisis. And there's many studies that establish that. And that's important because when you can do more sophisticated analysis on this. You could allow for the aging of populations, which Eva was talking about, which would take down that red dashed line another few tenths of a percentage point for some countries. And also you can apply it to individual countries. And the conclusion you come to is there were big costs from the financial crisis. For the median OECD country, the permanent deflection in output, GDP per capita, was of the order of 5 to 6 percentage points. And there are half a dozen small European countries where that deflection is 10 percentage points or more. So big losses, but the losses are not infinite. I mean, if you believe in the blue dashed line, they're infinite. Those two lines are never going to cross. But much more important than putting a number on the cost, it's the policy implications. And let me make that point. This is following the same sort of an analysis. It's using OECD estimates of potential output and decomposing it. So this is, the line is showing you trend productivity. And it's broken down into two components. One is TFP and the other is the amount of capital per worker. And the simple point, which applies to the OECD aggregate, is that much of the fall in the TFP happened well before the crisis. And that means if we're thinking about policies to address it, you should take that into account. I mean, for example, one of the explanations that is doing the rounds at the moment and is having a lot of support, and there's a lot of work going on at the OECD, is that there isn't enough competition in product markets, and that leads to a situation where winner takes most, and productivity in the laggard firms is well behind. Well, that's a different set of policies to focus on than if you believe the financial crisis explains everything. On the other hand, I think where the financial crisis did have a major impact is on investment. So if you look at the contribution of capital per worker, it's very much lower in explaining productivity growth after the financial crisis. What's the explanation for that? Well, if you've ever estimated any investment equation, you will know you will struggle to get the interest rate effect to work and have the right sign. If you really torture the data, you might get an uncertainty effect. But the thing that always works for every country, always, is an output accelerator effect. And that's what was going on here. You had a massive shock to demand. That led to lower investment. And that demand effect has an effect on supply via the capital stock. And work that I've done with OECD colleagues suggests that if you calibrate that accelerator effect and apply the shock that was the financial crisis, you can explain a lot of this fall in potential output after the crisis. So this is a chart which I'm going to skip because William talked about the labour market. Basically, there's not a lot of evidence that there are scars or anything like the scars that there were from previous downturns. I'll skip the conclusions because that's just repeating what I've just said, and just end with an advertising slide. If you're interested, there's more details on all of what I've been saying in these publications. But I think what's most interesting about these publications is the story I was telling for the OECD aggregate applies for virtually every OECD economy if you apply the same analysis. And that's what these publications were doing. And we're also in the process of updating these estimates for the 10th anniversary. So if you're interested in those updated calculations, please contact me. Okay, I'll stop there. Thank you.
Thank you very much, David. So we have had 4 different analyses, not contradictory, but looking at different angles. The question I still have is, what should be the policy that is followed? Is it monetary policy? Is it more competition? Is it a mix? Knowing that the basic element that has been put on the table is that, yes, there is recovery, so it's not so bad, but the debt level, leverage, financial system is already at the maximum. How can you solve that politically? Muddling through by trying to do something in the middle was never in history very successful. Taking blunt decisions come at a certain price. So what should be some ideas for politicians and central banks? I don't know who can start. Yes, David.
So I'll put my OECD hat on now. I think there's an answer which we give to most questions in regards to policy, and the answer is structural policy reforms. Because there's a lot of scope to improve structural policy, which gets away from this problem that fiscal policy and monetary policy can be constrained. There are recommendations which we make in a flagship publication, Going for Growth, and monitoring the implementation of those reforms. It's very clear that most countries are not following through. So we think that the obvious thing to be doing at this stage is to be implementing those structural reforms.
I would like to add something. Well, one of the implications of what I said, and this is also in line with what David said, is that the crisis was not only a demand problem. So in the crisis, there was clearly an effect, negative effect on demand, clearly on investment. But now we are in the recovery phase, and I think that the focus should be more on the supply side. And this is, it doesn't mean supply side, generally speaking, at this moment. It means linked to the understanding of what was behind the building up of the crisis. And this goes really in the direction of productivity and efficient allocation of resources. And on the productivity side, we saw that actually problems on productivity are a generalized problem because on the one hand, falling productivity growth drives down the natural interest rate. Of course, there is an effect on growth. So the implications are actually quite large. So when we talk about policy, I would say that monetary policy should get out of the business. I think it's time to go back to normal. Also in the view of maybe future needs. Of course, the macroprudential part should be there, and to focus more on structural policy, on structural elements. And this, I would like to add maybe an optimistic, again, sign. I have been discussed with a number of experts all this problem of productivity. And basically going back to this paradox of why we are having so technological change and actually we are not seeing in TFP growth. And one answer that was given to me, it was that actually we will see some big changes very soon, because there are a number of new technologies which are actually coming to maturity all at the same time, and these are likely to produce a big effect on productivity. So this would be a good news, because if productivity growth increases, also GDP increases, and then you have the easy way to the leverage, which is by growing.
A very comprehensive question. Just a couple of ideas I would like to contribute. Early on in the recovery in the US, we had for 2 years in a row the concern of a double dip. That is why we had not only QE1 but also QE2 and then Operation Twist and then QE3. In that time, there was a lot of reference to the stall speed, and that is a slow level of economic growth, which endogenously creates a collapse in confidence, which is then pushing the economy towards a recession level. So I think supply-side policy and everything that goes with it should target to increase the potential GDP growth and the average long-term GDP growth, so as to make sure that the starting level, when you have some headwind, is higher, and that as a consequence, the time it takes or the frequency that you reach the stall speed over different cycles would go down. The second point is that, of course, the obvious advice is try to avoid that you have a recession. Now, okay, that's a very heroic attempt, because recessions have always been around, so there will be recessions in the future. But nevertheless, having a mapping of where it may possibly come from is very important. Efforts have been stepped up very significantly. If you look at only one example, what the IMF is doing with the Global Financial Stability Report, I think there's also a major dimension of, I would say, coordination, because if you have a crisis, next time around it will not originate from the same spot. So that's also, by the way, why I insisted on developing economies and mapping where the sore points are, the weak spots are, globally speaking, I think is very important. Then there is, okay, how to fight them. I touched upon that in my presentation, but I think creating confidence that there will be a willingness to fight recessions and an ability to fight recessions and be credible in that respect in its own right will limit the detrimental impact of economic downturns. So it's absolutely key to display the willingness, the ability, and be credible, and do that on a coordinated scale. Now, in a world which is going from multilateralism to bilateralism on trade, this is, of course, a bit of an issue. In addition to that, as we have seen, monetary policy is typically conducted at the, let's say, national or regional level. Regional, I'm thinking of course, the Eurozone. And that also triggers then all sorts of spillover effects. Although, of course, you could, of course, suppose that in a global downturn, there would be de facto a monetary policy coordination. So being clear how to fight them, I think, is also very important, because it would contribute to creating a greater resilience. And then I would say that there is kind of low-hanging fruit, to use consultant speak. In my holiday in August, I kind of decided let's not read a novel, so I read The Courage to Act of Ben Bernanke and Stress Test of Tim Geithner. That's jolly good reading when the sun is shining. And one thing which is really striking is how little did we know back then. And that is, I think, something to take on board as well. Are we sure that we are providing enough transparency? And I think there is a specific role there for central banks to kind of contribute. Jacob, you mentioned the common good or the public good, and I think certain pieces of information should indeed be considered as a public good. I think it would be great that we would have a very clear picture of how credit risk is evolving based on very micro data, how all the estimates of the natural rate are evolving, that we would have a publication of where the terms premium in the Eurozone is evolving, etc. I think all these things would help in having people making better considered decisions.
Okay, thank you, Eva.
If I may add a bit, in my view, so this scars the legacy of the bad legacy of the crisis is very much, as you've spoken, the other speakers have spoken about, in terms of the supply, the potential output. So IMF estimates for advanced economies were 2% potential output growth pre-crisis, and now it's 1.5. So the high debt ratios as well. Public debt in the euro area is 90% of GDP. Used to be 25 percentage points less before the crisis. So in my view, these are the scars that of the crisis. What I spoke in my words before is more of the context, the long trends that are like demography is not the demographic trends are not the legacy of the crisis, of course, but it's the context in which we live now. Low TFP growth comes from predates the crisis, but really makes life difficult. So in this context, monetary policy is constrained, has difficulties bringing the real rate to the natural rate. Now, in my view, the focus of the space of the policies, and very much in agreement with what has been said, is in trying to promote growth and trying to bring these technological advancements into TFP, into TFP growth.